Right now, I mean, your newsfeed is probably just celebrating this 5-day pause in the U.S.-Iran conflict. If you look at the notifications on your phone today, this Friday, March 27, 2026, markets are bouncing, the pundits are exhaling, and, well, people are acting like the whole crisis is just resolved.
Yeah, they really are. And that illusion of safety is exactly what traps so many investors right now.
Exactly. Because if you actually dig into raw underlying data coming out today, celebrating this brief pause is, I mean, it's like taking an aspirin for a shattered femur.
Right.
The immediate pain might dull for a second, but the catastrophic structural damage is just completely untreated.
It is. We are hardwired to want conclusive endings. You know, a treaty gets signed or a pause is called, and we just categorize the threat as over. But the headlines are masking a permanent structural shift in how global power and energy actually function.
Which is exactly our mission for today's deep dive. We are looking past the whiplash of these daily war updates to uncover the true geopolitical watershed happening underneath. We're basing this on a brand new, incredibly comprehensive strategy report from Systematix Group.
And it is a dense report.
Super dense. And quickly, just for you listening, our sources today touch heavily on Iranian geopolitics, the U.S. administration, and President Trump's policies. We are absolutely not taking any political sides here.
No, not at all.
We are strictly looking at the financial mechanics, following the money to see what is actually driving the markets and, more importantly, your portfolio.
And that objective lens is just crucial right now because whether you are managing an institutional fund or just trying to protect your personal savings, understanding these underlying economic gears is no longer optional. The global economic architecture is literally being rewritten in real time.
Okay, let's unpack this broken femur analogy. To understand why today's headlines about a 5-day pause are so misleading, we have to look backward. The Systematix report argues this isn't just a regional spat, right? It's a massive rebalancing of global power.
Yeah, that's the core argument.
So how does this moment actually stack up against historical watershed events?
Well, what's fascinating here is how the current U.S.-Iran conflict combines deliberate supply disruption, massive infrastructure risks, and geopolitical leverage on a scale that honestly rivals the biggest historical shocks on record.
Like the oil shocks in the 70s.
Exactly like that. If we look at the 1973 Yom Kippur War, that caused a massive generation-defining oil shock. Then you have the 1979 Iranian Revolution, where strikes halted nearly 90% of Iran's output.
Right, and that pulled about 7% of total global supply off the market overnight. And the economic fallout from 79 lasted for years. I mean, it fundamentally changed inflation expectations globally.
It did. But look at the math today. Iranian actions have currently trapped or actively threatened approximately 15% of global oil supplies that transit through the Strait of Hormuz.
15%. Wait, so we are talking about double the relative supply loss of the 1979 revolution.
Double. And that strait is a narrow, unavoidable choke point. You cannot simply reroute 20% of the world's oil and LNG around the block.
And LNG is liquefied natural gas, right? Which has to be super cooled and shipped on highly specialized vessels.
Right. You can't just put it on a regular cargo ship.
So even if this 5-day pause holds, the physical infrastructure damage is already done. The report estimates damage at 1 to 3% of capacity. You don't just patch a bombed-out deepwater oil terminal with duct tape over a long weekend.
Precisely. Repairing that highly specialized infrastructure takes months, sometimes years. This is why Brent crude prices surging past $100 a barrel isn't a temporary spike.
It's the new reality.
Yeah. It reflects hard physical supply risks compounded by a massive geopolitical risk premium. Triple-digit oil is just a permanent feature of a new era.
Which means you, the listener, need to internalize that $100 oil is the baseline now, not some weird anomaly. But if this is a permanent structural shift, what is that structure actually built on?
That's the real question.
Let's transition from the price of oil to the sheer power of oil. Because this report goes deep into how U.S. hegemony influences global arms and oil dynamics, and the mechanics are kind of mind-blowing.
It really is the engine of global power at work. Washington has always maintained a tight grip on global oil markets to underpin its economic dominance and, crucially, to maintain the U.S. dollar status as the world's reserve currency.
Right, the petrodollar.
Exactly. The current administration's drill baby drill policy has obviously expanded U.S. domestic production, giving them sheer volume power. But the deeper, more aggressive strategy involves how they handle countries like Iran or Venezuela.
Because those are the countries actively trying to trade oil outside of the U.S. dollar framework. I always think of it like a casino where you can only place bets using the house chips.
That's a great way to put it.
Washington essentially demands that global oil is bought in dollars. This forces every nation on Earth to hold huge reserves of U.S. dollars just to keep their lights on, which artificially props up the currency and allows the U.S. to finance its own massive deficits.
That is a brilliant way to visualize the petrodollar mechanism. It is a closed-loop arcade, and it goes even further than just currency.
How so?
Well, those petrodollars, the billions that Gulf allies earn from selling their oil, are systematically recycled back into the U.S. economy when those allies purchase American weapons and defense systems.
Oh, wow. So they buy the oil in dollars and then spend those dollars on U.S. tanks and jets.
Exactly. The scale is staggering. According to the Stockholm International Peace Research Institute, or SIPRI, the U.S. now accounts for 42% of all global arms transfers.
42%.
Yeah. They are delivering weapons to 99 different states. In fact, mostly due to the Ukraine-Russia war, Europe has now surged past the Middle East as the primary market for U.S. arms.
Wait, let me push back on this for a second. Broadly speaking, isn't blowing things up and fragmenting global supply chains fundamentally bad for an economy? How does a global conflict actually help the dominant player?
I mean, it is terrible for frictionless globalized trade, absolutely, but it disproportionately benefits specific powerful sectors within the dominant power, namely the U.S. defense industry and the energy sector.
Okay, I see.
And the timing of this is incredibly relevant. The current U.S. administration recently faced a massive Supreme Court veto on its reciprocal tariff strategy.
Oh, right.
Because of that ruling, the government owes a massive $175 billion tax refund. They lost a major revenue stream overnight.
Ah, I see. So because the domestic economic agenda took a legal hit, they have to compensate by leaning even harder into their other levers of global economic control.
Exactly the dynamic at play. Controlling energy flows, exercising currency power, and dominating global arms sales forms an ecosystem that counterbalances those domestic setbacks.
It's all connected.
It improves U.S. trade balances while deliberately fragmenting potential rivals, like the BRICS nations, maintaining a state of controlled instability that deters anyone from challenging dollar dominance.
It is a macroeconomic balancing act played with live ammunition. But if global defense spending is beaming, I think the report notes it rose from $1.9 trillion to $2.7 trillion over the last decade. Why isn't the global economy looking at a post-war V-shaped recovery?
That's the trap.
Right, because after the 2008 financial crisis and the COVID-19 pandemic, we saw massive, rapid rebounds. What is the mechanism stopping that from happening now?
This raises an important question about sovereign debt and fiscal bandwidth. Those past V-shaped recoveries were fueled by immense government intervention. Trillions in stimulus checks, infrastructure spending, and quantitative easing.
Free money, basically.
Exactly. Those interventions were only mathematically possible because global debt levels were somewhat manageable and interest rates were at rock bottom. Today, the architecture is entirely different.
So to use an analogy, we aren't just dealing with a household that maxed out its credit cards during the pandemic. We're dealing with a household where the roof just caved in. That's the energy shock. And when they run to the bank for a loan to fix it, the bank sees they have zero credit limit left and just denies them.
And the data backs that up terrifyingly well. According to the Institute of International Finance, global debt hit a mind-boggling record of $348 trillion in 2025.
$348 trillion. That's just, I can't even fathom that number.
It's massive. The U.S. public debt to GDP ratio is sitting at 122%. The U.K. is at 105%. Japan is over 250%. And emerging markets like India are sitting around 85.5%.
But wait, explain the mechanics there. If Japan is at 250% and surviving, why is India's 85.5% considered a stress point?
It comes down to who owns the debt. Japan's debt is almost entirely owned internally by Japanese citizens and domestic institutions. It's essentially an internal ledger.
Okay, that makes sense.
But emerging markets rely much more heavily on foreign capital. If governments globally try to launch massive stimulus packages right now to fight the energy shock, they have to issue more bonds.
Right.
That flood of bonds pushes yields. The interest rates governments pay dangerously high. When U.S. bond yields spike, foreign capital gets sucked right out of emerging markets like India to chase those safer, higher U.S. returns.
which crowds out private investment and reignites the exact inflation central banks just spent 4 years trying to kill.
Exactly. They are completely trapped.
So they have to prioritize elevated defense budgets and bare minimum energy subsidies, leaving the cupboard totally bare for actual economic growth.
Which means we are staring down the barrel of severe demand destruction. Consumers and companies simply will not be able to afford the new cost of living. And this points to a massive blind spot where the quote-unquote smart money is totally misreading the room.
Here's where it gets really interesting, because I was looking at the fund flow data in this report, and it paints a totally different picture than the hopeful local headlines.
It really does.
Institutional foreign money is not waiting around for a V-shaped recovery. Foreign portfolio investors, the FPIs, have quietly pulled a staggering $43 billion out of Indian equities since September 2024. They already see the writing on a wall.
They do, and what they are seeing is the mathematical certainty of stagflation. That toxic, suffocating mix of stagnant economic growth and high inflation. The specific metric that overly optimistic investors are missing is corporate sensitivity to raw material costs.
Break the mechanics of that down for us, because normally companies just pass higher costs onto the consumer, right?
In the past, yes. If oil spiked, a logistics company or a manufacturer would just raise their prices, and you and I would absorb it at the store. But today, the consumer is exhausted. The report shows that the 10-year correlation between corporate sales and raw material costs is now approaching 1.0.
Meaning they are moving in perfect lockstep. Companies have completely lost their pricing power. They are being forced to eat the cost of $100 oil instead of passing it on.
Exactly the mechanism. If crude rises by 40%, which is the reality of moving to $100 a barrel, raw material costs for companies rise by about 20%.
Ouch.
But because the consumer is tapped out, sales growth might only be 12%. That delta is devastating. The report models that for non-financial corporations, operating margins could plummet from their current levels of around 15% all the way down to 8%.
Wow, that is not a slowdown. That is an outright earnings contraction. Half of their operating margin just wiped out by the cost of energy, just gone. So if corporate margins are collapsing globally, how does a country like India, which imports nearly all of its oil, survive that specific squeeze? Let's bring this directly to the listener's portfolio.
Well, India faces a deeply dichotomous vulnerability right now. On the positive side, the country has made commendable progress in diversifying its energy sourcing over the last few years, and they do hold about 10 weeks of strategic petroleum reserves.
That's a decent buffer.
It is. But the unavoidable reality is that India remains fundamentally reliant on seaborne crude imports. If crude sustains at $100 a barrel, India's oil import bill rises by an estimated $105 billion.
Good grief.
In local currency, that is an additional 10 trillion rupees drained from the economy annually.
10 trillion rupees. That is a staggering hit to the national wallet. And this is colliding with an economy where everyday domestic demand isn't exactly roaring to begin with. Right?
And that is the second, more dangerous side of the vulnerability. We just saw a massive GDP recast that scaled down private consumption by 20.2 trillion rupees per year.
Oh.
Yeah, domestic demand was already flashing warning signs before the first missile even flew. So you have weak consumer demand colliding violently with a massive, unavoidable supply-side cost shock.
The classic textbook setup for stagflation.
Yes. Inflation in India had been cooling down beautifully to around 2.2%. Now it has already rebounded to 3.2%.
Right.
And driven by higher fuel costs, supply shortages, and potential food price spikes linked to emerging El Niño weather conditions, it could easily spike to 6 or 7% in the coming months.
Because corporate profits are getting squeezed by energy costs, investors just aren't willing to pay a premium for those stocks anymore. This explains why the valuation multiples are shrinking.
Exactly.
The report notes the Nifty 50 trailing price-to-earnings ratio, basically how much investors are willing to pay for 1 rupee of a company's past profit, has already fallen to 20x.
And it will likely compress further. An 18x multiple is highly probable. The report suggests we are entering a protracted adjustment period. Prior to this geopolitical explosion, projecting a medium-term Nifty earnings growth of around 6% seemed entirely plausible.
And now?
Now, a flatter path, or even a modest decline in earnings, is the realistic baseline. The risk is heavily skewed toward both falling valuations and falling earnings simultaneously.
So if I'm a listener looking at my portfolio right now and I see the Nifty and Sensex are already down about 12% year to date, I shouldn't just grit my teeth and wait for a quick bounce.
Definitely not.
I need to know what dials on the macroeconomic dashboard to actually watch. If the environment is shifting this radically, what are the precise indicators of a market regime shift?
If we connect this to the bigger picture, you need to watch the metrics that reveal if the Reserve Bank of India, the RBI, is losing its grip on an impossible trinity.
What's the trinity?
They are currently trying to manage price stability, support heavy government borrowing, and maintain market liquidity all at the exact same time.
A tough juggling act on a good day, let alone when oil is $100.
Extremely. First, watch the 10-year GSEC yields. For the listener, government securities are essentially the interest rate the Indian government has to pay to borrow money for a decade.
Okay.
They are currently sitting around 6.85%. If rising inflation forces that yield to spike beyond 7%, that is a massive flashing red warning light.
Why is 7% the magic scary number?
Because higher government yields mean borrowing becomes incredibly expensive across the entire private economy.
So mortgages, car loans, corporate expansion, all of it just grinds to a halt. What's the second indicator?
The rupee. It is currently hovering near 94 to the US dollar. The RBI is using its forex reserves to defend it, but if those reserves deplete too rapidly under the weight of that $105 billion oil bill, the rupee is at severe risk of sliding toward 100.
Man, that would be brutal for imports.
It would. And third, keep a very close eye on India's current account deficit. Under sustained $100 oil, that deficit could exceed $100 billion, approaching dangerous vulnerability levels we haven't seen since the 2008 peak.
And looking at the government's response, the math just doesn't add up. They've allocated an economic stabilization fund of 1 trillion rupees.
Right.
But you just told us the annual hit from higher oil prices is 10 trillion rupees. That leaves a 9 trillion rupee hole. It essentially tells the listener to brace for sudden, unexpected tax hikes, right?
They have to.
The government has to find that money somewhere, and the report specifically mentions higher levies on sin goods or new corporate taxes.
The scope for taxing everyday households further is politically and economically exhausted. So yes, they will absolutely look to indirect taxes, expanding the definition of sin goods and leaning on corporate levies to plug that massive hole.
So what does this all mean for the listener's actual money? Now that we understand the brutal mechanics of the risks and we have our dashboard indicators, let's talk survival guide. What are the defensive asset allocation strategies for Indian portfolios during this regime shift?
You have to ruthlessly identify which sectors are insulated by their business models, which are actually beneficiaries of the chaos, and which are sitting directly in the crosshairs of margin compression.
Start with the insulated ones.
So relatively insulated sectors right now are IT services, telecom, and pharmaceuticals.
Because coding enterprise software, selling broadband subscriptions, or manufacturing generic drugs doesn't rely heavily on the daily spot price of a barrel of crude oil. Their margins are protected from the physical supply shock.
Exactly. Then you have the explicit beneficiaries of this crisis. Defense companies, particularly those with export capabilities, stand to gain massively from the heightened global arms demand we discussed earlier.
Right, the SIRI data.
Furthermore, companies involved in LNG pipeline expansion and non-conventional energy, so solar, wind, nuclear, are going to receive massive accelerated policy support as the government scrambles for domestic energy independence.
Okay, so that's where to hide and where to grow. But what should we actively avoid? What's in the crosshairs?
You want to exercise extreme caution with consumer durables and FMCG, fast-moving consumer goods.
Oh, because of the weak demand.
Exactly. Remember that weak domestic demand and the 20.2 trillion rupee drop in private consumption? That hits companies selling washing machines and packaged snacks the hardest. But equally important, avoid coal-intensive industries.
Walk us through the mechanism there. Why does an oil shock hit coal?
It's a cascading effect. Elevated oil prices force industries and consumers to shift toward alternative energy sources, which spikes overall electricity demand on the grid.
Oh, I see.
That sudden grid demand cascades into higher thermal coal prices. So if you are a cement manufacturer or a metals producer, your energy costs skyrocket, completely crushing your operating margins.
This is incredibly practical. And looking at how everyday retail investors are reacting, the data shows a really concerning behavioral shift.
It does.
The report cites that outstanding systematic investment plans SIPs have stagnated at 103 million since late 2024. And monthly mutual fund flows have dropped massively from 400 billion rupees down to just 230 billion.
What that data tells us is that smaller retail investors who are likely facing negative portfolio returns while inflation simultaneously squeezes their daily grocery budgets are quietly bleeding out.
Yeah.
They are pausing their investments and are trading from the market entirely.
Which is historically the absolute worst thing you can do during a structural macroeconomic shift. So the major takeaway here for you, the listener, is do not panic sell into a downward trend just because the headlines look scary.
Never a good idea.
Instead, use this mechanical intelligence to strategically rotate your portfolio. Move out of those high-margin risk sectors like consumer durables and cement, and reallocate into the insulated IT and pharma sectors, or the defense and renewable beneficiaries, so you can actually weather this protracted adjustment period.
It is entirely about calculated adaptation, not emotional capitulation.
Let's take a breath and recap the incredible journey we just took. We started by looking past the illusion of a 5-day war pause to see the real engine of global geopolitics, how the U.S. uses the closed loop of defense sales and the petrodollar to reinforce its global hegemony.
Right.
We unpacked the $348 trillion global debt trap that makes a 2008-style V-shaped economic recovery mathematically impossible. We could drill down into how $100 oil mechanistically compresses Indian corporate margins from 15% to 8%. And finally, we laid out the defensive playbook for your portfolio, rotating toward IT, pharma, and renewables, and away from heavy consumers of raw materials.
It is a complex web of cause and effect, but when you trace the physical threads from a block shipping lane in the Strait of Hormuz directly to the margin compression of an Indian cement company, the market stops looking like random, terrifying noise.
Right, it starts looking like a predictable, manageable chain reaction.
It really does.
But as we wrap up today's deep dive, I want to leave you with a thought that builds on everything we've unpacked today. We started by talking about treating a shattered femur with an aspirin. The world is desperately trying to put a splint on this crisis, hoping things will just magically go back to normal.
Yeah.
But if the post-WWII era of cheap, globally frictionless energy is truly dead, and we are entering a permanently fragmented world, well, will the cost of simply existing, heating our homes, buying basic groceries, powering our cities become so structurally expensive that traditional investing strategies are no longer enough to build wealth?
That's a chilling thought.
If the baseline cost of life permanently doubles over the next decade, how do we fundamentally redefine what a quote-unquote safe investment even is? Something to think about as you watch the markets this week. Expert speaker, thank you as always for your brilliant insights and for helping us connect these massive global dots.
It was a pleasure to unpack it with you. Thank you for having me.
And thank you, the listener, for joining us on this deep dive. Stay curious, stay informed, and we'll catch you next time.